Hello, everybody. As Rob said, I'm Adam Rosenberg. I'm a senior advisor at Blackstone, focused on gaming and leisure investing, both for the existing Blackstone portfolio and new opportunities. Among other things, I freelance a bit, and so I have some involvement with some other funds and companies that I invest with and advise. But I'm delighted to have this panel here today to talk about capital markets, what's driving activity for the kinds of investing that they do. But to set the stage, maybe we'll just go down the line very quickly, because I know the bios are all in the materials, just to say who you are and what you do, because I think that'll provide a perspective on the kinds of investing and or advice that this august group involves themselves in. So why don't you start, Lloyd?
Thanks, Adam. Thanks, everyone, for being here. Lloyd Danzig. I'm the managing partner at Sharp Alpha Advisors. We do primarily seed, some Series A stage investing across the sports, gaming, and entertainment landscape.
Cool, yeah. I'm Connor Williams, director at Velo Partners. We primarily focus on seed and Series A, probably more Series A these days, across gambling and gaming and the intersection thereof.
Sara Slane, founder of Slane Advisory, and I'm a board advisor to multiple startup companies.
David Egmond, managing partner of Bettor Capital. We invest in B2B software companies in the online gaming space at the venture capital stage.
And would you describe yourself as seed and A and B, or you tend to get involved a little bit later?
Yeah, even later. So venture capital being all the way probably till Series C, Series D, something that's slightly earlier stage, but have a broader definition of what we invest in.
Excellent. So I would categorize you all as early stage, given the kinds of companies and investments that I spend most of my time with, but I obviously have been getting more actively engaged and involved in earlier stage things. So maybe we'll just start, and whoever would like to answer can. There seems to be a structural shift going on in the supply and demand dynamics for capital around these earlier stage companies, whether it's companies that are looking to do follow-ons that are forced to consider down rounds or structure, or companies that are raising capital for the first time. Maybe you could comment on the dynamics as you see them and what is driving those dynamics.
Cool, I'm happy to take that one. So as well as doing a lot of VC stuff, we also take sort of very small LP positions in a number of funds, primarily on the gaming side, but actually also in the broader venture ecosystem as well. And definitely you can see that there is a shift in the flows of money, first of all, that are coming in on the fund side. It's primarily, I think, a function of the fact that interest rates have kind of remained, sort of higher than people were forecasting probably about a year and a half ago. And that's a function of really stubborn inflation that we at least don't see kind of going anywhere in the short term. I think that what that is doing is that's forcing startups to stop thinking about seed and Series A's looking as growth at all costs kind of rounds, and starting to realize that probably by the time you're thinking about a Series B, you need to start having what looks like a sensible business, as well as having, an interesting amount of growth tacked on, rather than, burning $1 million a month and no one's kind of batting an eyelid at it. So I think that's a big change. And as you said, there's actually a survey that we saw about a year ago where it was a US survey of a bunch of US asset managers that they've done for the last 15 years. And this 2024 was the first year where there's ever been more respondents saying that they reckon there are going to be more down and flat rounds than up rounds. So that is very telling from a broader venture perspective about how nervous GPs are at the moment of the actual ecosystem.
Mm.
Yeah, I would just add, I think in 2021, certainly when online sports betting and online gambling in the US was taking off, you saw a lot more direct investment, whether high net worth individuals, family offices, less formal funds saying, hey, I want to find the next DraftKings, the next FanDuel, and put money into this huge hyper growth trend. I think as things have pulled back, you've seen a lot of those dollars, to Connor's point, exit the market. And so you have fewer dollars of capital, fewer institutions, and kind of the family offices or adjacent investors are no longer really active, or at least not highly active in the online gaming market like they were several years ago. So I think that supply-demand equation change is really driving what you're seeing in the marketplace.
And I'll just say, I think in the beginning, there was obviously a lot of irrational exuberance around the potential opportunity without kind of really understanding how difficult a business it is, how well established the gaming industry is, and how you're going to crack into it. So it's just required a lot more nimbleness, I think, on the innovator side.
Well, I'll pick up on some of the themes. You know, David, you mentioned that you focus on B2B businesses as opposed to B2C. And I think that's a flavor of some of the shift that we see also among investors generally, in part because of the large costs involved in B2C direct businesses. And that stresses this point you made, Connor, of the balance between growth and profitability. Are you exclusively B2B? Are there exceptions? Would you call Jackpot an exception? And how do you think about some of those factors that I just mentioned?
Yeah, there always has to be exception to your guardrails or your guiding principles when you see massive opportunity, and certainly we did in the iLottery space with Jackpot. I think fundamentally our thesis as a firm is we don't really want to go head to head with the FanDuel or DraftKings, where it may take billions of dollars of capital to go up against them. We want to be in adjacent verticals where things might be less competitive, more rational, or certainly in the picks and shovels where you just don't need that much capital to reach scale and self-sustaining profitability. So that's been a core part of our thesis, is what are areas of the ecosystem we can invest with attractive margins, less competitive, and we're filling a void where we're not going up against the big behemoths who have billions of dollars of capital and more resources.
Yeah, it makes sense. It tracks with what we're seeing. A lot of the best risk-adjusted returns are sometimes found in the B2B space, where margins are better and sales cycles are more predictable and customer acquisition costs aren't astonishing. But most likely, on an absolute basis, the largest outcomes will be B2C opportunities, just because the lifetime value of customers is so large in this space. And to Dave's point, I think a lot of investors, whether direct or LPs, they don't really have appetite for fighting a customer acquisition battle with a DraftKings, a FanDuel, or a Fanatics directly, but that doesn't mean there are not other B2C avenues like iLottery, for example, and perhaps others we'll discuss now or in other panels, where there is quite an attractive B2C opportunity, and you aren't necessarily suffering from the competitive customer acquisition dynamics that you would if you were just trying to launch another recreational-focused fixed odds sportsbook.
And I mean, just adding on what Lloyd said, I think it's also that, and Dave sort of mentioned it too, I think there are a lot of tourists in the early days, and I think when you're touring in a sector, especially in early stage, you tend not to be applying first principles when you're doing that. So if I think about B2C now, I think we're probably more interested in B2C now than we were 4 or 5 years ago, where distribution is how you win in B2C. You only win by having a distribution advantage, right? UA, that's pretty close to next to impossible to beat out a DraftKings or a FanDuel. But I think what we're seeing, Telegram, WhatsApp, these sort of things are getting referenced more and more. There's a step change in the number of distribution channels, particularly outside of kind of stereotypical app stores, where we're starting to see more and more blue ocean play. And I think that's where, quite frankly, you're getting CACs that are scalable rather than CACs that are at $250 and you need 30 million, just to kind of get you to having an interesting revenue number, never mind break even.
I'll just build on the tourist point. I was going to use actually a similar answer to your first question, but my fellow panelists answered it so well. Something that we've observed, I think everyone knows, it's been a lot harder for startups to raise additional funding and to exit. And what that means to VCs is that they aren't receiving and making distributions from which they can pay themselves and their team bonuses. And they're not marking up their portfolios in ways that allow them to go on and raise new funds, the management fees from which fund their compensation. And so because of that, I think everyone here would agree, VC is a great career. There probably are some better ways to make more money as a financial services professional with a lot less heartburn these days, now that money's not flowing in the way that it was. So you see some of the tourist investors fade out of the market. And then similarly, founders and entrepreneurs who previously were able to raise money more easily, sign B2B customers more easily because those companies themselves had a lower cost of capital. Again, many of those perhaps so-called tourist founders have also been filtered out of the market. And so I think that what that means is if you are a founder in the market today, you're competing for fewer dollars and you're competing with, on average, a higher quality competitor. And I think those dynamics, exactly as Connor described, are what we're seeing play out in the capital markets.
Very interesting. So this is not a scripted question, but you bumped into it. So I'll ask, is there pressure for VCs like you to be absorbed by bigger institutions? Do you see yourself bumping up against the same co-investors in all of your deals and see an opportunity for larger, more established platforms who want exposure to earlier stage, in particular gaming and gaming tech? Could there be a fit there? Do you see some absorption of your businesses into larger platforms?
I think there's been a big phase, at least in the US, over the last some number of years, where the largest name brand institutional capital allocators have found themselves hitting up against a ceiling of the possible AUM that they can charge fees on. And so you start seeing them spin out new funds with new brand names or absorb more niche specialty funds so that they can continue raising and
spin out. You don't mean separate. You mean raise capital around those items.
Spin off, but still maintain ownership of a new fund that maybe Blackstone would say to a particular executive, "Hey, you're doing a great job. We're going to spin off Adam Rosenberg Capital LP. We'll put in half the capital and we'll introduce you to our investors. We want a piece of the performance fees. We want a piece of the management fees, but we're going to let you do the marketing, you be the face of the business." And we've received several what are called GP stake offers and offers like this from firms of that nature, and so far have not pulled the trigger on any. Connor mentioned they make some LP investments. We have a lot of household name growth equity firms that weren't quite ready to tell their LPs and announce to the world that they're investing in gambling, but maybe wanted to get some curated deal flow from the earlier stage. So there definitely are a lot of conversations of that nature taking place. I don't yet know, unless Dave's entertaining a big buyout offer that I'm not aware of, if you're going to see any of us get sold to a larger institution, at least this year.
Okay. I want to push a little bit more on this concept of the balance between growth and sustainability or profitability. It seemed to me that during 2023, there was a great push for the public, large OSB providers to pull back on the spend and the bleed and focus on profitability. Some are getting there, some are not. Do you see that as a theme that will play out in 2024 the same way it did last year in terms of pressure from the analyst and investor community to focus on profitability?
It certainly feels that way. Some of the bigger public operators have either reiterated their profitability targets, whether it's a 25 EBITDA goal or otherwise, and some have even reached that on a quarterly, monthly, or now annual basis. So I think the pressure will continue. A lot of the conversations that our portfolio companies have, since most are B2B, is how do we bring modern tech and help you save money versus maybe a legacy or incumbent supplier that you're utilizing for things you want to continue to outsource? And we're certainly seeing that as a theme. We're also seeing, I think, some of the large operators start to acquire. I know we'll talk about M&A, but doing tuck-in acquisitions when you're evaluating build versus buy versus rent, and you're seeing more operators do that to help their path to profitability in the future, or accelerate their profitability by owning certain pieces of technology versus renting that. So I think that market backdrop and pressure will continue to exist.
That's great, and that's exactly where I wanted to go. Sara, maybe I'll pull you into this as we talk more about M&A. There's been a few deals announced recently that are capturing headlines. One is DraftKings' acquisition of Jackpocket. Seems like a reasonable price to me that they're paying for it, especially relative to my understanding of recent rounds of capital raise. Is that a reflection of the fact that these earlier stage companies are having more trouble continuing to raise capital on their own and will be pushed more into the arms of bigger suitors?
Yep. So what I was actually going to say, building off what Dave was saying earlier, was, I think, a couple of years ago too, just looking at the number of entrants into the marketplace, and everyone assumed there was going to be a lot of M&A activity around the Churchills and the Wins, the Fubos, and that clearly did not take place the way that I think everyone thought it could. What seems to be happening now is a much leaner, smarter way of making or going through that M&A process. And if it's a new vertical or it's new, I think when they were evaluating companies like a Win, you weren't really value add. It's the same, other than some specific market access pieces that ended up taking place, but no new customer database, really, no new tech. So I think it's, the pendulum is definitely swung back now to the market leaders as they start to evaluate where should we be deploying dollars then for M&A activity.
I think the other thing I wanted to say is, tying back to what we were talking about, there was this deluge of funding that came in over the last 4 or 5 years, and quite frankly, across VC in general, but certainly in sports betting in the US. And what tends to play out when that happens is there tends to be 2 real winners to that. The first winner is the end user, because product tends to get pushed by a lot of these B2B businesses. And the ultimate, sort of trickle up to that is that the end users are, FanDuel, BetMGM, DraftKings, and so they're getting a better product experience. I think the other real winners tend to be the incumbents who buy the tech, because they're essentially getting it, certainly in certain instances, for a discount on what they would have had to put in, whether that be man hours or cash. It tends not to be the investors who win out there, because too many dollars chasing too few deals tends to bid things up, and you get what's called multiple compression, which really, it hurts your return in the longer term.
And some of the companies that were fortunate enough to raise capital at high valuations are now paying the price for that, because the market has caught up with those valuations, and they're being forced to consider either up rounds that are not on pace with previous rounds, or flat to down rounds, or outright support from existing investors to keep funding the business.
Yeah. I mean, I think a lot of founders are becoming pragmatic about it, and I think you're seeing more and more bridges of decent businesses where existing shareholders are happy to kind of carry their pro rata. I think in the long term, it's a good thing, because I think it builds a much more robust business, much more robust founder. I think the concerning side is more around certain down rounds where founders are getting wiped out completely. So, you're talking going from 40, 50% of a business to owning 10, and that basically breaks the venture model, because you just don't have a founder that's got enough skin in the game to, be burning 110 hours a week, basically. So, I think there's some structural issues there that are going to play out in the next year, where you're going to see some of those businesses likely exit for pretty cheap, I think, because founders just don't have the right incentives to carry on.
I spoke to another VC the other day who told me he advises his portfolio companies to always raise at a valuation no higher than they would be able to sell the business for at that moment. Certainly that's not what people were doing in 2020 and 21. And, one of the reasons it ends up being such prescient advice, and I think all of us are seeing this now, it makes me sad sometimes to see fantastic businesses with great with great solutions to important problems and great management teams. And really the only problem is that the valuation is now headed in a downward trajectory that also might wipe out the founders or cause a need for a recapitalization. And it's a shame to have done all the things that are so hard to do correctly and only find yourself in a difficult position because perhaps you got a little over your skis with valuation, and now there's a perception that you haven't grown fast enough, or perhaps you're decelerating or even shrinking. And if anyone's a fan of the HBO show Silicon Valley, they have an entire episode on runaway valuations, and a character who says, "Oh, I wish someone told me I could have taken a lower valuation. No one ever told me that was an option." And I think it's season 2, episode 1, for anyone who wants to check that out later. So that is something that it's tough, and we do see, and at the very least, what you have to hope is that founders raising money today have learned that lesson. I think you don't want to be the meme of a founder who raised at an inflated valuation in 20 or 21 and doesn't realize that they're hanging on to unrealistic expectations as they continue to try to raise capital today.
Well, it requires discipline, and it reminds me, I spent the heart of my career as an investment banker, and when you price an IPO into a very frothy market, you're faced with that question of, do we take full advantage of that and often if there's no secondary, there's really no reason to anyway, versus creating some running room for the stock to grow, letting the investors who come in at the IPO see some movement as opposed to taking every last dollar. It's not always an easy conversation to have with a client, and I imagine it's a similar dynamic between the VC you mentioned and the management team, but it is prescient advice. Sara, you mentioned when I asked about the Jack Pocket acquisition of DraftKings that it's an adjacency. And clearly there's cross-marketing and strategic benefits to those businesses, which DraftKings has articulated well. What are some other adjacencies that you all are seeing that you expect to become part of the story for these mainstream operators, whether it's sweepstakes or other kinds of businesses that are pre-regulation, regulation adjacent, or otherwise?
It's funny because I was thinking about this morning. It's like the tale as old as time. I mean, I've been in the industry now over 15 years, and just to see sort of the pushing of the boundaries of regulation, and I think it definitely, I came from the brick and mortar side, so I worked at MGM for 8 years back in the early 2000s. And did a lot on the BD and development side. And back then it was, bricks and sticks and where can we go find our monopoly and build our next big shiny building. And now it's obviously accelerated with this pivot toward mobile and sports betting really leading the way, which is what we sort of knew when I was at AGA, what this was going to kick open the doors to more innovation. I think it's, as we're having this conversation too with startups, and I think the frustration has been, on one hand, this industry has moved leaps and bounds over the past 6 years since PASPA has been struck down, but it's just not quite fast enough with tech stack integrations. It's just not happening at the rate I think that a lot of innovators are used to or have done this before, unfortunately. So I do think that there is sort of this natural tendency then for bottom line to move the needle to look to these other adjacencies where it may be a little bit questionable around their regulatory and legal makeup, but hey, you're adding new customers, you're adding to your bottom line. So not at all surprised to see the sweepstakes, obviously the differentiations on all the DFS products. It'll be really, again, I say tale as old as time. It's not like this is new news. It's just a new iteration of what's out there, and it's going to continue to happen.
Yeah, I would add to that. I think anything you can make a bet or a wager on legally, the leaders are going to want to offer that. The question is around regulatory clarity and regulatory certainty. And I recall being at FanDuel pre-PASPA, and we went to Las Vegas to meet with a few casino companies. And one, we had to spend an hour with their compliance person because they were so concerned that if we met an executive from Caesars, we might somehow poison them because we were illegal gambling or call their reputation into question or have some licensing ramifications. So when you create new industries and push the boundaries and you go into whether certain regulatory gray or use precedent that's 20, 30, 40 years old, I think the question becomes for the big players who are heavily regulated, what's their regulatory risk appetite? But certainly over time, as that regulatory clarity is achieved, everyone will want to be in those businesses.
I think Dave said it well. He said anything you can legally place a bet on, the big operators will want to have under one roof. And I think that's absolutely true. That's what we hear from operators. Connor and I have been talking about horse racing recently. There's bingo, there's real money trivia, sweepstakes, DFS plus, things like that. But then I would say maybe something that is not new, but like maybe a new flavor is we're also seeing cross-pollination and cross-selling into non-betting categories. Fanatics is doing, ticketing, merchandise, and sports betting all in one place. DraftKings now has lottery. They have their NFT marketplace. Most of the operators are offering streaming. You could see more types of those integrations being built out. So I do think we are at least now starting to test the waters, not only on the boundary of what is legal real money gaming, but what other broader sports gaming and entertainment cross-sell opportunities can there be? Is there a one-stop shop that exists for all of a sports fan's needs or all of a gamer's needs? And if so, who's well-positioned to be that? And what are some of the technological connective tissues that have to be created in the meantime? But that is a slightly new dimension. The destigmatization and mainstream appeal of sports betting in particular, I think, has fomented discussions for integrations into the broader entertainment landscape, not only other forms of real money gaming.
I think the one other dynamic that I think is quite interesting that I don't think gets talked about enough is there is a push and a pull of kind of living on the edge of all of this, which is, the more kind of prize picks of the world have great success, the more targets go on their back, the more regulators look at them. So while on the one hand, you've got this sort of notional distribution opportunity for the incumbents to acquire, you've also got the other side of it, which is as these new forms of betting are created, it definitely ramps up the regulatory pressures as well. And I think from a startup perspective, where that gets interesting is I think if you're in early enough, you can kind of see the blue sky and you can dream. But I think once you're starting to get to kind of, numbers north of 50 mil on valuation, you've got really real asymmetric downside risk that, I think people are becoming more and more cognizant of in the last, I'd say, 2 years.
I've also seen the dynamic where, regulatory risk can be exaggerated to a point where it dissuades you from doing something that's otherwise sensible, especially if the acquirer is a well-behaving, regulator-embracing operator, so that if they have issues, they'll work through them, as opposed to just shunning a category because it has some challenges. In my experience, gaming is a one-way ratchet of expansion, and when businesses succeed, again, as long as they're not outwardly flouting the law, if they genuinely want to be on the right side of regulation, there's a way to work through it.
It's hard. I mean, I think
you've seen different.
This is where I think it's great. Like, I feel like I'm an old lady up here, but where I love the fact that there's so much innovation that's happening in the space right now, because it does come with ignorance a little bit, but it comes with ignorance, right? And I just having lived with MGM and when we in Macau, and then what ended up in New Jersey, and they ended up having to give up their property there, and it was a big mess. It comes with a once bitten, twice shy. So you're dealing with a lot of that. Like, is the juice really worth the squeeze? Is this really going to help the company at the end of the day? Because the regulatory scrutiny on the other end, is that what's it going to cost me? So that was, quite frankly, back in, 2016 with, maybe it was 2015 with DraftKings and FanDuel, the considerations then that, they didn't want to meet with Dave because it was like, well, we are a multi-billion-dollar company, and are we really willing to put at risk our licenses for something that we're not quite sure is legal? So there's always going to be that check and balance. I don't disagree that in rational terms, obviously that makes sense. We need to advance the industry. Clearly there's a marketplace for some of these products that are out there that may not be legal. And that was part of the consideration from the gaming industry with DraftKings and FanDuel, was there's demand. Customers want this, and we want to be able to enter into that marketplace, but we have to have the blessing from the regulators in order to do so.
Well, maybe
You and I have
you're
talked
highlighting
about the idea that if you're a good actor with good intentions, you can figure out the regulatory risk, and I do appreciate that philosophy. I think there are some poker executives or former poker executives from this industry who would disagree with that tactic, and so certainly it has not worked out, at least for everyone.
Well, I understand that, and Sara, to your point, I think maybe what you're highlighting is there's some differentiation in the buyer universe in terms of companies that are more or less likely to embrace change. And, to cite FanDuel and DraftKings, who were on the other side of that issue not that long ago, now as, those who are simultaneously pushing for expansion but protecting their own territory by enforcing regulation, is part of that evolution. So it could be that the MGMs of the world may not grab it as quickly as some of the newcomers are, even as the newcomers become, proven large, profitable enterprises. You wanted to say something, Dave?
No, completely agree. Well said.
Okay. We are out of time, so please join me in thanking the panel. That was a wide-ranging, interesting discussion. Thank you all. Very good.